Okay, so here we go. Good morning, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for April 16th, 2023, the Euro session. So these are from Hamad, so thank you, sir. We'll take a look at the first question, the multi-time frame, multi-lens analysis. The question is, are there specific questions we need to answer, patterns we need to take note of while looking at the charts in order to have specific actionable points, objective points? I agree. Have you seen this this chart before?
Yeah, I have. I've kind
Okay.
of created my own charts on Excel as well. So
Yeah. Okay. Yeah, I realized when I opened it up, I had this. I had to clean up the spelling on this little block, so it's a little bit different than the one you have. I will upload the cleaned up version. So there's a couple ways that you can do this to add specific checkpoints, and some of these are really straightforward, some not. You heard me talk at the last session, I think, on the MACD Four Seasons and looking at the signal line with respect to the Bollinger Band. That one is as objective as it can be. Do you have any specific questions on that one?
I think my questions are more related to the
To the patterns,
to the patterns, because I don't think they're properly mentioned in the
like
documents
this
we
one here,
received.
like
Absolutely.
in the RLCO.
Yeah.
Okay, yeah, I'll yeah. So just for folks that are listening, so the MACD, what we're looking for is winter, spring, summer, or fall as a seasonality, and we're looking to see where that is with respect to the Red River, because that will tell us. This little piece is important because it's in the winter and it's outside the Red River. That makes it a really good opportunity to get short. And then when it turns into the spring, this is almost premature right in here when it's in the spring and outside of the Red River. If I like the pattern, I might give it a try. That's the one that's gonna most likely fail. And if it does, then I have a winter, spring, winter as an auto short. Once it gets into the checkpoints of the Red River, I might put that in green so you can see it. When it enters the Red River, hits the midpoint and crosses, it's the spring is getting progressively stronger, and I like the fact that there's still some spring left before it gets into the summer. So I will typically try to enter somewhere in that pathway through the Red River, especially if there was still room outside of the Red River before the summer. And then obviously when you have the Red River goes that far below, it really leaves room for an extraordinary move to the upside, because what you see in that kind of formation is this exaggerated winter that goes well beyond the Red River creates a harshness and a real psychological shock, and then it takes all those little monkeys many phases to be able to fully believe in the market again. So you end up getting what can be a very extended move, where you get the first mouse, the second mouse, the third mouse, the fourth mouse, the fifth mouse, and each one coming in and confirming that that the sadness is over, until it gets to the point where there's nothing left. There's nobody left to buy, and here you are at the peak of a summer outside of the Red River, and then the fall gives you plenty of time to harvest. And then when you're looking somewhere down in here, is this fall going to turn to winter? If it doesn't and becomes summer, then that becomes like a kata 2 in the MACD. So briefly, those are the things that on every time frame, and these correspond really to just any time frame that you might want to be trading. I like looking at all of them, especially with SPY for the market, so that I can get a sense of where everybody in all their different time frames is looking at. Because what I've learned is that if you have these 5 different time frames, each guy is more or less prone to action. Let's say like the first guy is only this much interested, the second guy is this much interested, the third guy is hardly interested at all, and somebody's really interested because of the pattern to act, and this guy is hard. So you get very different levels of agitation and excitation. And one of the things that we will forget is that we're the only person looking at the chart and price through our particular lens, whatever that may be. And if we put blinders on, we forget that there are these other reasons to act in one way or the other, or not to follow through. And then when suddenly these guys go from not interested to very interested, suddenly this pile of money comes into the buy and sell formula, and then you get a surprise of a continuation or a sharp reversal that you weren't expecting, because on your time frame maybe there wasn't any reason for an exaggerated move. So in general, having these different time frames is a structured way to ensure that you don't get locked into your own tunnel vision and committing the fallacy that, oh, everybody's looking at exactly the same chart I am, and then trying to make so much sense out of it that you get very, very complicated inside your own time frame, when it's really just standard patterns being applied from these other time frames. So I wanted to say that. On the relative pinch and stretch, really what I'm looking, I actually think that the the Bollinger Bands are really the way to do that. Is the Z3, it'll look something like this. Is this really an exaggerated stretch compared to all the previous ones? And then when it comes down to the all-important pinch, depending on the time frame I'm in, there's going to be some definition of a pinch that if the Z3 lines get inside that, then we're going to alert objectively and say that's an abnormal pinch. And so intraday, I'd like that to be a frog box. And why is that? Because on the candidates I like to trade, there's typically 3 or 4, call it 4, frog boxes inside the range stat. Or inside the daily range, let me put it that way. So if I get some condition in which there's a very tight pinch, this would be ideal. That if this was the low of the day, and then I saw the 2 Z3 lines pinching inside a single frog box, I know that if this thing breaks out here, then it could, that maybe all this range compression could really expand, and it wouldn't be a surprise if it just moved a range stat. And I could have 3 great big boxes of gains because of the abnormal compression inside there. So pinch and stretch relates to those. So in the abnormal pinch, and then I might say on the abnormal stretch, if I see, this is going to be on a Z-score +3 and -3, and so the Bollinger Band mean would be there, and I can see the width of the Bollinger Bands is always identical in that time frame. So now I always have 6. I have 6 boxes between Z3 and Z3. Well, that means I have from Z2 to Z2, I have 4 boxes. So what happens if on any time frame I can look at this and say, hey, price moved down near the Z, it went past Z2, found support down here, and has now started to cross back over Z3 or Z2. I can actually now set that up as a tradable box, perhaps. I now can give it one standard deviation on that time frame, and I can set up a buy and I can set up a sell. And then when I go north, I either have, 1, 2, 3, 4. I have 4 to the far side Z2. Just getting back to the Bollinger Band mean, I have 2 units of reward versus 1 unit of risk. Well, I don't have to actually trade that, but at least I can say that somebody on whatever time frame I see that kind of pattern on, those guys might be triggered by a move of this far off the bottom. Or if I'm exactly at the, maybe price did this and it came right back and is sitting on the Bollinger Band mean, I might be able just to say, if I can put a risk box on that, the river, then the breakout may be wide enough. So now what I can do is compare the physical size of the box of the standard deviation in that time frame, and then compare that to my MMRB. Is that a manageable risk? I already know that it's reasonable it can get back to the Bollinger Band mean, so I always have a 2-to-1. So this really comes from the idea of trading from Z2 to Z2. So as I look now at the range of potential, volatilities, what I really care about is how far is the excursion from the zero line, to very quiet volatility. Now I'm concerned. I now have something like a pinch or a Z3 pinch in this case. That can be a breakout in either direction. Or I can be looking, so that's the very quiet pinch. Or the stretch, I'm really concerned about. From a distance I can see, oh, that's a really exaggerated pinch, and it has started to curl. Is it still expanding? Well, then I'm in the middle of a raging trend, and maybe I can get a hold of that until that such time as I see the Z3 lines start to roll over. That tells me, that was the maximum stretch in that time frame, and now I can be concerned about the reversion to the mean trade. What if it went all the way to the extreme, came back to the Bollinger Band mean, and then started to go again? Now I can project and say, oh, maybe it's going to get that far, and there should be a 3-to-1 or 2-to-1 just to the previous Z3 excursion. So I can now start using pinch and stretch in the Bollinger Bands and MMRBs and whatever I'm using for the unit of risk, the manageable risk. It may not be the technical MMRB from the intraday, but on whatever time frame I'm looking at, that thing could be a frog box, it could be an ATR, it could be a standard deviation of the last 30 time periods, whatever that may be. So there's some objective measure that I can use to frame the trade location with respect to pinch and stretch. And as a general rule, I love trading from Z2 to Z2. What I love to see on any time frame is some price that made a Z2 excursion and has started to turn, so that I can see a very measurable objective turning point. And that's the beauty of the RL10, by the way, is that gives you a very precise point. It makes a V bottom every time because of the way the math is constructed. So no matter how far it went, when I see it hit that turning point, then I have this much room between Z minus 3 and Z2 to frame the trade and make a decision and see, do I want to just go back to the Bollinger Band mean? And so maybe, I've got 2 units of that kind of stuff. So this is a really important alert for me. And then the pinch and stretch just simply says if it's really compressed, the Z3 lines break out, and then a Z3 breakout works. And then I can look back to see how far was the previous excursion and use that as some kind of measured move. And I might be able to use just the width from Z3 to Z3 might be enough of a box. Heck, from the taking half of that, taking the Bollinger Band mean to the Z3, once that thing starts moving, maybe that's all the risk I need to take. Very specifically on the 3-minute bars, when I'm using that 1/10 of the range stat. But what I want you to relax a little bit and see is that just the Z3 lines and how much they've pinched or expanded gives you the ability to rapidly frame these kinds of breakout trades, or after a stretch, a reversion to the mean trade. Check or hold. I'm going to assume that was okay. Okay, so now specifically what you asked me for was on the RLCO. I needed to get that other stuff out of my head. So there's 2 generations of RLCO patterns. Generation 1 is very precisely defined. And there's a document that I'll send you that has that. But in general, 2, 3, 4, 5, 6, 7. So pattern number 1 is simply the RLCO. That's the regression line crossover outside the river. And pattern 2, God, it's been so long, man. So anyway, I'm gonna send you the document that has each of those. And what we first learned was that we started trading these with very precise entries and exits. And let's see. Our number 7 is the Anderson regression line stretch. Number 6, if I remember, was a Z3 excursion and then a reversal back up through Z2, Z minus 2. Pattern 5, if I recall, was a tightly compressed breakout from the river. 4 was the case where you had a pattern 1 and it got through the river, came back to the edge of the river, and then resumed. That was really strong because you had an excursion below the river. It got all the way through, and it didn't get an exit. It made a move all the way across the river without ever hitting an exit. Then it made a peak. It came back and then found support north of the river and started to resume. That's like the most powerful kata 2 you ever saw. So that was pattern 4. Was a strong, what we would now call a kata 2. Pattern 3 was it got past the river, Bollinger Band mean, but didn't get out of the river, came back and held support and continued. So this was sort of like a normal reversion to the mean. It made an extreme move. It got successfully back to the Bollinger Band mean and beyond, held support and was continuing. Pattern 2 was it failed before the Bollinger Band mean. In other words, it got in here and then started failing right away. So we started trading those things, and pattern 1 we discovered actually failed enough that pattern 1 failure became a collapsing dragon. So as we started working on Generation 1, what we have now learned is that not only are these definable, actionable patterns, but they also just give you information about where the market is and what price is doing, and it also gives us a language to be precise. So now you can use the 7 patterns of RLCO1 Generation 1 to be very specific about what it is that you see on each of these time frames. On Generation 2, we now have taken all the things that we've learned for trading those 7 patterns for years, and we brought them over, and then we started naming very specific subsets or moments. Like the first one was the owl, and the owl has 5 criteria that you have to see before you get in. The first one is it had to have a successful P1, meaning that price had to go, or RL10 had to go outside the river. I'm going to do it in blue. So it had to leave the river, which was up in here. It had to leave the river, so now it's an exaggerated move, and then the RL10 has to cross over the it has to reverse and cross over the RL30, outside the river. So if you see that, that is the exact definition of pattern 1, an RLCO. Had to have been outside the river, reversed and made a cross over the RL30, still outside the river. Now, we used to just trade that one by putting a risk box on it, and that failed enough that you can still do it, but you got to be ready for the collapsing dragon, which is the preferred one. So we said some people didn't like the high failure rate. They wanted something, they were willing to give up some of the earlier gains to get a higher win rate, if you will. So we said the owl was formed by saying, look, if the first pattern was 2, then it had to be it had to cross the let's see. Oh, I think it was the winter had to turn to spring. I've got the owl pattern somewhere. I don't want to tell you wrong, but it was number 2 was winter had to turn to spring, and that normally happens in between the turning point of the RL10 and the edge of the river. The important one was I remember. Okay, pattern 2 was it was the RLXD. That pattern or the criteria 2 in the owl was that the RL10 departed the river. Criteria 3 was that it crossed the PSAR. Criteria 4 was that the dragon slope rolled up, so you were getting this from this low point in the dragon. The slope had now turned up. And then the 5th criteria was the RL30 rolled up. 4 was the dragon rolled up. So when the RL30 itself, that was usually the last thing to turn, as soon as that went from negative slope to positive slope, you now had the owl. And what that meant was that you were getting entries in here, not earlier in the noise, but it had made more moves above, and you had a little more confirmation, and so you got an owl entry somewhere north of the PSAR flip. And what made this really successful was that when you had these exaggerated winters, you had to have a harsh winter. And that meant like intraday 1.5 frog boxes. So it had a significant adverse move. And that meant the MACD Four Seasons was in the winter. Or from a distance, you could see that, oh, that looks like a massive sell-off. So this had to be a non-controversial, harsh winter. You might have even traded that out of a small risk box. And the best thing of all was you had some manageable risk box up in here, and you got some kind of strong move, and then it reversed. So the fact that that was a very good win meant that you had the harsh winter, which could lead ultimately to an owl reversal on its way back to something like some measured fair value up in here. Maybe that was a range stat move intraday. Maybe it was the RL 270 on that time frame, whatever it could be. But there was always enough so that if you got the owl in a manageable box, there was still 2-to-1 up to some reasonable price level. So I say all that just to say that the owl is one of the named patterns in Generation 2. The SSC, the collapsing dragon, the Kata 2, the Z3 pinch, and the super pinch. Those are all very actionable patterns that you see me trading on the swing trades and on the intraday sniper trades of the day. Those are the patterns that the sniper triggers on. Well, what you can do is now you can look at the way price is shaping up and you see, is there a specific P1 through P7 pattern that's either just activated or is getting close? So you could be like if you were stalking it. And then if you look at these, the owl, the SSC, collapsing dragon, K2, Z3P, super pinch, is any of those in the process of forming, or did it already occur? Would you have already seen an entry in the owl? So this is prices after an owl, but it hasn't reached the range stat yet. So it gives you some sense of where in the life cycle of that oscillating price we are. And so that's what I mean by looking for standard pattern recognition. Now, there's some other ones that we use too, like the WMB3 is a very simplified pattern. There's one where it's just a visual box trading where we've defined a box by some definition of it. I can see it's that much, and I just see that a price has moved that far off, and I can put a box on it, and that box is manageable, and there seems to be some reasonable. So even a field expedient pattern that you may have developed in your life, any pattern that you already know that you like can be used inside of this. It doesn't even have to be the RLCO. If we just made that a pattern, and now you can use the expertise that you've developed in order to have very specific things on your checklist. So what I would do on this is, as you're learning these different patterns, or you prefer one pattern or another, you start making your own personalized checklist of the things you're looking for. And then as you add skills, or you add models, or you add confidence, you can start adding to each of these little sections. So for me, the support and resistance really is strictly the dragon and the RL10, where those turning points are. Turn out to be really important statistical measures. What I want to say about those two is that the dragon is slower to move and more rounded than the RL10s. So the dragon is going to look like in some typical move is going to look like that, however wide the dragon is. You know, you'll get some kind of turning point in the dragon. And because the RL10 stays closer to price, you know, that might be what price does. You'll see that the RL10 always is closer to price than the dragon is because of the way the math works. And it'll kind of always look like that. I should have put, this price should have been like that. Sorry. Then the RL10 is going to look like this. So when I'm looking at support and resistance, the two places that I will take one right from the top of the dragon is one, and then one from the actual peak of the RL10. So there's always like these two. One is the distance between the dragon belly to the dragon hump is always going to be inside the RL10. The RL10 is sort of like the point of last resort. When it gets beyond there, it's really gone. But if I see it get up into here and it starts turning at the dragon, I'm already acting on that as a reversion to the mean. Because that tells me that it's more likely to revert to the mean because it couldn't even get past the edge of the dragon, much less to the absolute peak of the RL10. Does that make sense?
Yeah, all good.
Okay. So I think that's what I wanted to say about the patterns, the generation 1 and 2, and we've got the definitions of those, and I'll get those to you. But really, this is intended to be a systematic way for you to look at multiple time frames so that you don't get locked into one particular screen and point of view. And then this is just a way that you can use 5 different lenses to make sure that you're getting really distinct alternate perspectives. And what is helpful is if you even had different screens that just showed the indicators for those things, you would get fresh looks at what's going on. And then in the examples of those videos, you can see where I start at the monthly and go all the way down. And in that, I'm drawing like, if like price was in here or something, I might be drawing these different lines where of resistance or action, like a price ladder. And then when I go to the weekly, I start adding some more. And then what I end up having is some kind of integrated price action ladder, so that when this starts breaking out, it's like, hey, if it breaks out above here, I can be long. But if it gets to here and doesn't break through, then maybe that's all there was. And then that helps me invoke the 2R battle drill at each of these potential, what ends up being like support and resistance lines or actionable lines. It may not even look like support and resistance because that could have been driven by a statistical measure and not necessarily a place where price specifically turned. If that was just where the Z3 line was, nobody will see that unless they're using our indicator set. So what you end up with is something like an actionable price ladder to help guide you on places where price is more likely to have a reversal or an explosion. Okay? So that's what I wanted to say about that. We got about 15 minutes left here. So let me drive on through here. Okay, so I think I've answered that one. Let me come back to this here in the middle. My view on trading the pre-open, I'm going to say yes and no. I'm going to say no most of the time if you're using equities. I'm going to say it doesn't matter, first of all, because academic research shows that in the pre-market and the post-market, for equities that there's no informational content in this, that they have not been able to find ways to take the information from here and translate that forward into what the market's going to do afterwards. So if you're trading equities, I would say don't bother with that until you get the large volume of orderly moves so that our patterns, which are based on statistics, work. This is a small sample and usually a small population, and the psychology of the guys that work in the aftermarket and pre-market are different than the guys who are just trading the regular session. So I don't believe that the rules and the practices that we have refined over here necessarily work over here. You may find that they do, but I don't assume that they would. So there's a whole new body of work that you have to do to prove that the patterns from over here work over in here. So my default position is they don't until you change my mind and I see something that works. Now there are some things that work for in advanced trading. Like if you're in the Forex, that really doesn't make sense. But what you got in the Forex is really in a 24-hour session. You have peaks and valleys, explosions and whatnot, and so you get 3 separate 8-hour sessions in the Forex or one 24-hour period. So there's no real sensible way to say, trading outside the market. Same thing with the large indexes that are trading in the futures. So futures and Forex kind of the same way. You can still see that. You can trade that as its own thing. Now, it does have some information content as you are approaching the new open. You can say, well, yesterday that closed here, and because of the pre and then post market, and then the post market and the pre market, this thing is indicating that it's going to open here where it closed there. So I can now determine, yeah, that's going to be a large gap. So what I am more inclined to do, instead of trying to trade this, just be ready to have a bracket order around the big gap so that I can play the explosion from the gap stat. So that's the way I would play that. Does that make sense?
Yeah, tons.
Okay. The time frames that I trade typically are 1, 3. I look at the 5 sometimes, but I don't really trade it. The 10, 30, 60, and then 2 hours daily, 3-day, 9-day. The 5s is either too fast or too slow. I like using the 3 rather than the 5 because in a 30-minute window that starts here, the 5-minute only gets 6 bars, so he's making a decision every 5 minutes. But on the 3-minute, I can make a decision at 3 minutes, at 6 minutes, at 9 minutes, at 12 minutes. At 15 minutes, we're both making the same. We're making a decision on the same closing of our bar. Only mine's closing on a 3-minute bar, and his is closing on a 5-minute bar. So just for in this, and just in that range right there, I'm actually front running the 5-minute bar. I get 2 data points. I can react to the 5-minute with a second decision. I'm front running the 10-minute decision with another react. So that looks to me to be so much better than the 5-minute, and it gives me plenty of time to decide. 1 minute I can trade, but usually only on 1, maybe 2 symbols at the most. But only 1 entry at a time because that's happening so fast. Then when that one gets established on the 1 minute, I can convert it to 3-minute management for the long grind. Or I can trade to 3-minute, and then if it looks like it's stalling, I can dial back down to the 1 minute in order to refine my exit. That's if I'm being really active. If I'm doing the swing trading intraday, like you see me brief in the evenings on the swing portfolio, I'm using the 30 as my primary. And I might dial it down to the 10 to get a refined decision. And sometimes I might even go all the way down to the 3. But I like the 30 and the 3 and the 2 hour and the 3 day as my to encompass intraday all the way up to swing. Okay. The other time frames are tradable. It's just I have defaulted to what works for me. I like the fact that from 1 to 3 has a multiple of 3. 3 to call it 10 has approximately a multiple of 3. Has a multiple of 3. This is a multiple of 4 to get to the 2 hours, but 4 is almost 3. You know. So I like seeing that kind of fractal relationship in those times. So that's just kind of what I've settled on. Okay, so this one on the PSAR, or let's see, MMRB. So getting a 2-to-1 position sizing risk to reward. Yeah, so if you're on a 3-minute... Here's the main idea that I would say. There's some hypothesis for the trade which says I have some reason to believe that it was reversing, whether it's up or down, and that if I put a stop here and my entry here, and I've scrunched that as tightly as I can, I'm maximizing the number of those units of reward to risk in either direction. And the emotional experience of this is that I get excited when I'm making that trade. And so the tighter I make that, the larger the number of shares that I can have on it. So in order to keep from exploding and going off the deep end, I try to trade it at 1/5 of the risk. You can do that a couple ways. You can reduce your dollars by a fifth, by 80%. Or you could require that the move to the top takes 10 of those. Because I wanted 2 full R, and then I'm going to make the execution risk equal to 0.2. But now it can be hard finding, sometimes intraday, 10 boxes of reward inside a normal position. So the ideal would be 10. I could live with 6. And that so one of the examples I gave you was, how about something like this? Let's say I have a range stat that's that big. That's the maximum reasonable intraday move. Maybe that thing moved down to the previous low of the day, and now it moved a frog box off the low. There's probably 3 frog boxes available to the upside. But what if I was able to do a entry at the frog box, but then instead of using the full frog box as my exit, maybe my trigger might be just this, half a frog box. That would give me 6 to the upside. So if I just maybe I used the frog box as my position sizing. That's only a 3-to-1 difference between the frog box and the MMRB, but that achieves the same psychological effect. What that means is that if you took that as a loss, then you'd be getting a 0.3 loss instead of a 0.2. What if you just said, maybe I have a 6-to-1 reward to risk ratio in there, but I'm going to psychologically say if that equals my exit, I'm going to set that equal to 0.2. So I'm going to take what my standard risk per trade might be and I can divide this into pieces and say I'm only going to risk $40 inside that box or something. But the point I would make on this is that rather than trying to be strict on the on the 10 to 1, what I'm trying to get you to achieve is to break the connection between your enthusiasm and optimism on seeing a trade that you want to take and trying to maximize your position size by using this as the risk box, or as the position sizing. Because in some cases, like on utilities or Brazil, we might be getting down to 4 cents because the doji got compressed to 4 cents. And now on a $400 risk per trade on a 0.04, I could have 10,000 shares. Well, what if there's a blip and that thing violently breaks? And if I'm getting a doji near a turning point, I expect a lot more failures. So instead of burning out by trying to maximize the position size, I would say, look, if you can see 6 units of that risk, then you're probably okay. And use 3 times your risk box. Trade at 1/3 of what you want to max out for your position sizing. Here's another just simple way to do that. You just say, look, whatever criteria I have to justify the reward to risk trade, maybe you just want 2 to 1. That's fine. Take the risk box for that trade and then calculate the max position size. Like I said, if it was 0.04, and I can say, well, I'm going to risk $400. Oh, awesome. I could have 10,000 shares. Just divide that by 5 and say, I'm just going to trade 2,000. And what you have effectively done is you've only accepted 1/5 of the risk. Then if this thing failed, you only lost $80, which is equal to 0.2 of your $400 of risk. So what you're doing is you're using the conservative risk management factor of 1/5 to do that. So there's 2 reasons to do it, or there's 2 different ways I just said it. One of them is to wait to see a physical pattern that says I could get to that reward if I took this little risk, and there's 10 to 1 inside here. What that does is it makes sure that you're waiting for a massive enough move to reverse that there's a reasonable chance for it to go that far. And that keeps you from getting chewed up inside Crocodile River, because there's so many resistances and supports that you'll realize, oh, I'll never get out of that. So I'll never see the reasonable 10 to 1. But if you had a great big breakout, harsh winter, and starts to reverse, you could see 10 to 1. So that is filtering out suboptimal patterns. But you could also say, let me have these risks. Let me take the risk box, calculate the maximum position size, and then back into the size of the trade, taking 1/5 of the maximum position size. And then you would achieve the same effect of not getting caught up in your optimistic mind. So we have a rational mind that covers us 2/3 of the time. 1/6 of the time we have our optimistic mind, and 1/6 of the time we have our fear-centered pessimistic mind. We use pessimistic mind to stop trading a system or to start fiddling around with the rules. We use our optimistic mind to position size on a system that our rational mind is persuaded is any good. And the problem is that the optimistic mind gets way too large, and then the pessimistic mind runs away, and so we never give the system a time to become what it's going to be. So that's the answer I want to give you for that. We got the creativity guys getting ready to start. So what I want to do is close this session, let the recording start. I'll get it posted, and then as you go back and listen to that, if there's additional questions, just give me a follow up in writing, and I'll continue to refine answers as we go, if that sounds fair to you. Fair enough?
Yeah, that's really good. If you can just send us the document with the P1 to P7 patents, so I can review them on my own.
Yeah, look inside just for right now, do old man a favor and look inside the Foundations course. You should see a place in there where it has all the reference documents loaded. If I don't have it in there, then I'm a monkey's uncle. But I will make sure that it's there and also email it to you. But that'll give you an experience at trying to find all the reference documents. So I owe you the Generation 1 and Generation 2 documents. But that will give you might be able to get it faster that way. Okay?
Cool. Thanks.
Yep. Cheers, fellas. And creativity guys, I'll start this in a half a second.